What we've got today is a landmark day, not just for our two companies, but also for the British financial services industry. For Lloyds ASB, the takeover of hbos is a unique opportunity for us to create the largest and the best financial services business in the United Kingdom. The combined group will be a great, strong British bank.
Welcome to this special episode of Panorama, where we shall be examining whether the government was right in its decision to sanction the creation of a super bank and whether the creation of this monopoly would affect consumers and how. In this particular episode, we will be discussing why Lloyds and hbos had to merge. We will also be looking at the competition law and what it had to say about the merger. We will be hearing from the Prime Minister, Gordon Brown, and his views on this merger, as well as having a look at how the creation of a super bank will affect consumer interests.
The recent economic climate, as it is, meant the media had ample ammunition to create an environment where fear was prevalent amongst consumers regarding the security of their money in banks. This phenomenon started to occur with the hbos group, particularly so when their share prices began to plummet, reaching a devastating low of 88 pence per share. This was extremely low when considering a year ago the same shares were valued at £11.65. Therefore, when depositors and lenders began to withdraw their money due to the falling share price, the hbos boardroom voiced their concerns to the government. The government, in turn, more out of fear than necessity, and wanting to avoid another Northern Rock fiasco, approached Lloyds and asked them to buy hbos, therefore hopefully ending the speculation about the uncertainty of the hbos group. However, our investigations concluded that it seemed the merger was necessitated by panic rather than any fundamental problems with hbos themselves.
Usually competition watchdogs such as the Competition Commission, whose role it is as an independent public body is to ensure healthy competition between companies in the UK. The Competition Commission would have examined this particular case and more than likely would not have let the merger occur and be processed. This is generally the case in mergers when larger companies will gain more than 25% of the market share, leading to substantially less competition in that particular UK market. However, in this case, a clause in the competition law was invoked. It states that competition law could be overridden if there was a national interest at stake. The national interest here was that any failure of hbos would have an immensely damaging impact on the UK economy. This is due to hbos being the market leader in saving, as having a customer base of 22 million. Therefore, the government waved this deal through, with the Prime Minister himself actually helping to broker this deal. Here is what he had to say on the matter.
We've taken the decisive and the tough decision that was necessary to protect the stability of the financial system and to protect the depositors. And we've done so, just as with Northern Rock, because it was necessary to get the financial system moving forward today.
Consumer welfare will be affected as there is a lesser degree of competition in the financial services market, as explained to you earlier by my colleague. This monopoly will need strict regulation by the Office of Fair Trading in order to maintain consumer interest, especially so in the mortgage market, where combined Lloyds TSB and hbos earn 30% of the entire market. Otherwise, with the lack of competition activity, prices for the consumer may well start to rise. With their restriction of choice coupled with low levels of activity in the market, consumers in the mortgage market are particularly at risk from market abuse by such a dominant force in the market. However, to prevent this from happening, close monitoring from watchdog groups such as Which and the Office of Fair Trading need to be undertaken. Other markets which Lloyds and hbos operate in include the small to medium enterprise market, savings products, loans, insurance and credit offers. Close regulation will also be required in all of these different markets as well.
This lack of competition is highlighted even more so in Scotland. This is due to the Scottish market being dominated by hbos and the Royal Bank of Scotland, which makes up 70% of the market in total. The remaining 30% is shared between Clydesdale and Lloyds TSB. The merger would then mean that instead of the market consisting of 4 major banks, there will be only 3, therefore seriously reducing consumer choice as well as competition. As a result of the merge, there would also be a market which is concentrated within these 2 big banks, creating a virtual duopoly, meaning there will be an impact upon the choice available to Scottish customers both in retail and wholesale, and a reduction in the number of products available to them. There was a strong case for the merger not to happen, particularly in Scotland, as its banking structure differs to England. Here is what Lloyds have to say on the merger.
We just did an enormously good deal. This is fantastic. I rarely use superlatives, but this is really a good deal. That for the Lloyds TSB shareholders, we're getting a huge increase in net asset value. From a customer point of view, we're building a wonderful catalog of brands that we can use to target our customers better. We're getting a wonderful distribution system, and as you know, we have leading positions now with the combination in current accounts, mortgages, savings accounts, and so on. So it's really something that creates a wonderfully powerful franchise. We'll be able to serve our customers very well. We'll be able to add great value to them, and we'll be able to grow for our shareholders.